While many stocks are currently considered overvalued following their recovery rally following the corona crash, Barclays strategists are optimistic about UK stocks. The stock markets were unpredictable in 2020. First, the big corona crash that nobody saw coming, and then the stock markets recovered at breakneck speed, faster than the economy was able to recover from the measures to contain the corona pandemic. Some indices even reached new highs. But how long can that really go on? Some experts are currently critical and warn of the impending bursting of a bubble. Meanwhile, Barclays experts see opportunities for a particular group of stocks. They recommend buying stocks from the UK. While vaccination campaigns against the coronavirus pandemic have started in numerous countries, optimism on the market is increasing somewhat. Even if the number of newly infected and deaths continues to rise in many places, the corona vaccines, which are gradually receiving approvals or already being vaccinated, give investors hope. This is also reflected in the stock market. After the tech stocks in particular benefited from the developments relating to corona last year, investors now increasingly switching to companies that could benefit particularly from an economic recovery thanks to the COVID vaccines. One index that has received support from this development in the new year is the FTSE 100, which was posted an impressive performance so far in 2021. The FTSE 100 has grown by around 4% since the beginning of the year. And in comparison, the Stoxx Europe 600 rose by 2.03% in the new year. The S&P 500 can show an increase of just 0.32% in 2021. That was on January 18th. The British index owes its good performance primarily to the so-called stocks such as mining and energy stocks, which are strongly represented in it. The heavyweight in the FTSE 100, which includes BP, Royal Dutch Shell and Anglo American, all recorded double-digit increases for the few trading days in 2021. Barclays strategists recently upgraded UK equities to neutral or market weight after a terrible 2020 in a notice to clients, describing UK equities as a cheap reflation game with defensive hedging. Defensive sector weights make the UK an unlikely outperformer but offer a hedge. Brexit will weigh on GDP in the years to come, and the UK COVID outcome is among the worst, but a stronger recovery in activity could result when vaccines are successful, says MarketWatch, depicting Emmanuel Chow's team. Global PM's portfolio managers have stayed away from exposure to the UK for the past 4 years. This was mainly due to the binary tail risk of a crash out that outweighed the appeal of UK assets, but also because only technology and growth intensive indices were the place to be, said the strategist. The UK is relatively cheap and under-owned, but this has gradually been reversed as domestic stocks and GBP have received a bit recently. While Barclays strategists advise investors to avoid stocks in the healthcare, staple food, telecommunication and real estate sectors, they recommend commodity stocks, financial stocks, industrials and discretionary stocks. The titles that the Barclays experts have classified as overweight include BP, Anglo American, Weir, Serco, Wizz Air, Red Crow, SSP, Grex, Avast, WPP, Foreign Print Group, BT, AstraZeneca, Convatec, Tesco, Imperial Brands, Unilever, National Grid, Lloyds Banking Group, Legal & General, 3i and Segro. And if you want to stay informed, please subscribe to my channel and my other channels. I'll see you in my next video. Auf Wiedersehen.